This video is for general educational purposes only and should not be considered financial advice. Investing involves risk, and you should always do your own research before making investment decisions. In our last video, we looked at choosing an expiration date. Now it's time to make another important decision. Which strike price should you choose? If you've looked at an options chain, you've probably noticed dozens of different strike prices. Some are below the current share price. Some are exactly at the current share price. Others are well above it. So how do you decide? Just like choosing an expiration date, there isn't one perfect answer. Choosing a strike price is a balancing act between cost, probability, and potential return. Let's see why. Let's look at ABC Company. The shares are currently trading at $100. You decide to buy a call option. When you open the option chain, you notice several available strike prices. $90, $100, $110. All three are call options, but each behaves differently. So which one should you choose? Let's start with the $90 strike. Because the shares are already trading above this strike price, this option is in the money. It already has intrinsic value. That means it's usually the most expensive of the three. Next is the $100 strike. Because the strike price is close to the current share price, it's considered at the money. Finally, we have the $110 strike. Because the shares haven't reached that price yet, this option is out of the money. It usually has the lowest premium because the shares still need to rise before the option gains intrinsic value. Let's compare them side by side. Remember, there isn't one perfect strike price. Each one has advantages and disadvantages. This table shows the trade-offs. This is where the balancing act begins. An in-the-money option costs more because it already has intrinsic value, but it's also more likely to retain value if the shares move as expected. An out-of-the-money option costs much less. That means you can control the same number of shares for a smaller upfront investment. But the shares must move further before the option gains intrinsic value. The lower price isn't automatically better. Neither is paying the highest premium. You're balancing cost, probability, and potential return. Let's imagine you believe ABC Company will rise from $100 to $105 over the next few months. The $90 strike would already have intrinsic value and would probably benefit from that move. The $100 strike may also perform well because the shares are moving above the strike price, but the $110 strike may still finish out of the money. Even though you correctly predicted the shares would rise, you may still not reach your strike price. Being right about the direction isn't always enough. You also need the shares to move far enough to match the strike price you've chosen. So why would anyone choose an out-of-the-money option? Because if the shares make a very large move, the percentage return can sometimes be much higher. The trade-off is that there's also a greater chance the option could expire worthless. An in-the-money option is generally more expensive, but it already has intrinsic value and often behaves more like the underlying shares. Again, there isn't one correct choice. The best strike price depends on your expectations, your risk tolerance, and your investment strategy. Many beginners automatically buy the cheapest option they can find, but a very cheap option may be cheap for a reason. The shares may need to rise a long way before that option becomes valuable. On the other hand, some beginners assume the most expensive option must be the safest choice. That isn't always true either. Instead of asking which option is cheapest, try asking which strike price best matches my investment idea. Here's another simple rule to remember. Choose a strike price that matches both your expectations and your risk tolerance. The strike price should reflect how far you realistically believe the shares could move before your option expires. There is no perfect strike price, only the one that best matches your investment idea. Now that you understand expiration dates and strike prices, you're ready to learn something completely different. Until now, we've only looked at buying options. In a future video, we'll explain what happens when investors sell options instead. That opens the door to strategies like covered calls and cash secured puts. Let's quickly recap. An in-the-money option usually costs more because it already has intrinsic value. An out-of-the-money option is usually cheaper but requires a larger move before it gains intrinsic value. Choosing a strike price is always a balancing act between cost, probability, and potential return. So remember this simple rule. Choose a strike price that matches both your expectations and your risk tolerance. If today's video has helped you understand call options and you'd like to learn much more, I've written a book called Profitable Stock Options Trading: Lessons I Learned Losing $100,000 to Accelerate Your Trading Success. The book covers real trading experiences, common beginner mistakes, trading psychology, risk management, and practical option strategies that I've developed over many years of investing. If you're serious about learning stock options, the book is available on Amazon, and you'll find a link to the book in the description below. If you found this video useful, please subscribe to Practical Assets. It costs you nothing, but it really helps the channel grow. Thanks for watching, and I'll see you in the next video.